There is absolutely no question that climate change is material to the future of the insurance industry. We're talking about decades more than years, but over coming decades, climate change is going to become one of the most strategically important risks to our sector. We are already today seeing a shrinking addressable market in terms of what we can sell. We're seeing the actuarial assumptions under which we write product, they're having to change. And from the investment business, which is where I work, we're also extremely concerned that there's an ill-defined value at risk. In other words, climate change, as it changes, will have repercussions for the businesses that we invest in. What value will be eroded from them, and what is that worth? Governments have to correct the market failure that climate change represents. Investors can exploit the market inefficiencies and make more money from the problem, but that is not going to cure the problem. The problem has to be dealt with by reshaping the way the markets are currently incentivizing fossil fuel consumption to be undertaken at a rate greater than that which the planet can absorb. Now, the way you go about correcting market failures is through pricing system change. You can do that in a range of ways. One, fiscal measures, so a tax or a subsidy. Two, a trading scheme like we've seen in Europe with the emissions trading scheme. Or three, standards or regulation that says you simply shouldn't do this. The first thing we need is a material price on carbon, which makes it relevant to valuation, which means that when we're investing in companies, we are automatically going to be biasing our capital towards companies that are doing this stuff better, more efficiently, and are providing solutions to the climate change problem. If we are able to do that, these companies will be rewarded with a lower cost of capital, which means they'll be able to outcompete their competitors as a consequence. The cost of capital is fundamentally important, and for that to be influenced, we need a carbon price. That is the most important thing that governments can do here today. I learned an enormous amount from the meeting today. It was an absolute pleasure to be there. I think the most important thing that I took away was there is much more interest in getting the data to investors around how companies and other institutions are performing in the area of climate change. I was particularly pleased to hear the OECD talk about what they would be doing on fiduciary duty and developing guidance for that. And I was also intrigued by a commitment that was made around the G20 and what they might do on generating better data from companies that list. If I look at the G20 and I look at the companies in those jurisdictions, and I look at the greenhouse gas disclosure, in some jurisdictions you get 1% of the companies disclosing their greenhouse gas emissions, and in other jurisdictions you get 92%. That's a world of difference, and we need that standardized and made consistent. So I was very pleased to hear the challenge on IOSCO, the International Organization for Security Commissions, for them to step into this problem and solve it. And I think they would be a very welcome actor.